Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Ollie's bargain outlet stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Ollie's Bargain Outlet is a chain of discount retail stores. The first store was opened in Mechanicsburg, Pennsylvania, just outside Harrisburg. It has 388 locations in 25 states. It sells brand name products including housewares, bed and bath, food, floor coverings, health and beauty aids, books and stationery, toys and electronics. The reason it is able to sell products at such low prices is because of its various sourcing strategies. One example is it contacts stores like Target or Walmart and takes all of their excess inventory off their hands. Ollies may buy holiday products from Target a day after the holiday ended. Or if Walmart ordered too much Nabisco shredded wheat cereal and they could not sell all of it, and Walmart needs to make space to put other cereals on its shelf, it may sell the excess Nabisco shredded wheat cereal to Ollies at 10% of the cost, which is better for Walmart as opposed to just throwing it out. Ollies has deep, long-standing relationships with hundreds of major manufacturers, wholesalers, distributors, brokers, and retailers. So they're always on the hunt looking for the best deals. The ambience in its stores and its marketing is witty and humorous by using caricatures, bright colors, and designs. Its store count has grown by a 14.4% compound annual growth rate since 2016. Same-store sales has grown by a 19.3% CAGR since 2016. They do not have any stores on the West Coast, just the eastern half of the US. The company has 2 distribution centers that can support 500 to 600 stores. 95% of its distribution comes out of its York, Pennsylvania location. The other 5% is from its Commerce, Georgia location. Its stores receive shipments from its distribution centers 2 to 3 times a week. It may vary depending on the season and specific store size and sales volume. The nice thing about its business model is that it has positive financial performance during strong and weak economic cycles. The weaker the economy, the better this company performs. The company is headquartered in Harrisburg, Pennsylvania, was founded in 1982. It IPO'd in 2015 at $16 per share. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 4.4 billion market cap. They're trading at $68 a share, and they have 65 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they were cash flow positive in 18 and 19. But then it blew up in 2020 and 2021. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's positive each year. Revenue is the sales for the company, and that grew a lot from 2019 to 2020. It's at 1.8 billion in 2021. This is the company's income statement. The top line is the revenue of the sales. Here's a breakdown of their sales. 16% in housewares, 11% in bed and bath, 10% in food. So 90% of their sales are non-food items. People call Ollies a treasure hunt because you never know what you're going to get on a specific day. Most items sell out pretty quickly. They don't stay in the shelves for that long. 8.5% from floor coverings, 7.7% from health and beauty aids. Then you have books and stationery, toys and electronics. A lot of things fall into these categories, and they still have 27% of other. So there's a huge selection at each store. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. This includes the cost of the merchandise it buys, also inventory markdowns, shrinkage and transportation, distribution and warehousing, and also depreciation. Revenue minus cost of revenue gives you your gross profit, and that grew from 500 million to 720 million. Below that is their operating expenses, and this includes payroll and benefits, marketing and advertising. Also the cost to maintain each store. That includes rent, insurance, and electricity payments. Then below that is their operating income, which grew from 160 million to 259 million. And the bottom line of the income statement is their net income, which is positive and strong each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they generate between 100 million and 360 million of cash flow. 2021 was their best year. And they spend $30 to $80 million a year in CapEx. This includes the land for the store, the building they construct, and also other expensive items that go into the store. So you can see pretty much all their CapEx is in investing cash flow. So they're not acquiring any companies, at least for the past few years they haven't. Operating cash flow minus CapEx gives you your free cash flow, and they have positive free cash flow every year. They don't pay a dividend, but in 2020, 21, and the trailing 12 months, they bought back about $76 million of stock. That's another way to reward investors, is to buy back stock. Because when a company buys back stock, it decreases the shares outstanding, making your shares more valuable. It looks like they needed to pay down $1.4 billion of debt in 2019, so they added $1.3 billion of debt. So you can see they didn't issue any capital stock. So you can see their shares outstanding are going up a little each year. It went up a lot here. That's pretty close to the time it IPO'd. Why are the shares outstanding going up since 2019 when we just looked at the statement of cash flows and they didn't issue any capital stock? Some investors hold convertible debt, which they can convert to equity, which increases the shares outstanding. Also, some people own options, and they can convert those options to stock. So there are various ways for the company's shares to increase without the company doing a capital raise in the secondary market. This is the equity section of their balance sheet. They have $1.4 billion of equity. They raised $660 million from selling their business, and they profited $815 million from running their business. So that looks really good. They received $658 million from investors, and they provided a profit of $816 million. That's what you want to see, a profitable company. Just before, we were looking at the statement of cash flows, and they bought back about $76 million of stock. That's treasury stock. When a company buys back stock off the open market, it puts it onto the balance sheet as treasury stock. This is a contra equity account, so it brings down your equity balance. Let's look at the capital structure. They have $1.4 billion of equity, $400 million of debt. So they're 78% equity, 22% debt. Their net debt is negative $40 million, so they could pay off all the debt with the cash on their balance sheet and still have $40 million of cash left over. So they're essentially debt-free. Because if you had a $300,000 mortgage and you told me you have $100,000 of cash in the bank and you had $400,000 of investments in stocks and bonds, I would say you're pretty much debt-free. But if somebody else said they have a $300,000 mortgage and $10,000 of cash in the bank and $20,000 of investments, I would say they have $300,000 of debt. And I gave them a WACC of 7.5%, which is the middle WACC on Finbox. Simply Wall Street always has really low WACCs, which means their valuation will be a lot higher. I'll show you later their valuation. And this is the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $5.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.6 billion. We divide that by 65 million shares. And we get a calculated stock price of $71. They're trading at $68, so they're trading at a 5% discount. It's a buy according to the model. The average analyst projects their revenue to grow 11.5%. I grew their revenue 11.5% a year for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by these 4 revenue numbers. And that comes out to 9%. So I multiplied their future revenue estimates by 9%. That's how I got their future free cash flows. And it's interesting to see that I'm coming out with a stock price really close to where they're trading at. Look how high Simply Wall Street is, $128 a share, because their WACC is so low. It seems like they value stocks a lot higher than most websites do. I think it's a safe strategy, because if they say a stock is overvalued and the stock goes down, then that company can sue Simply Wall Street saying the reason their stock went down is because Simply Wall Street said it was overvalued. I know it sounds crazy, but these are things companies need to think about when they give out financial information. 12 analysts priced this stock and the average price target was $83. The low was $56, the high was $108. 14 analysts priced this stock. The average price target was 85. The low was 56. The high was 107. 14 analysts rated the stock. 5 a buy, 2 outperform, 6 a hold, 1 underperform. Nobody rated a sell. This is where the stock has been trading since it IPO'd. It was trading over $90 a share at a couple of points, but now it's trading much lower. So if you're really bullish on this stock, then you want to invest in the stock when it's not trading at its all-time high. If a stock is trading at its all-time high, I'm not saying don't buy it, but ideally you want to buy it with the most upside possible. Mark Butler was the co-founder and was running the company since 1982 when he died unexpectedly at the end of 2019. The stock was trading at $69 when he died. He was really well loved by all the employees and lots of customers. So this had a pretty big negative impact on the company because his death was so unexpected and he wasn't that old at 61. The stock started going down after his death. Then a few months after he died, coronavirus hit, and in March the stock went up a ton because restaurants were closed and everybody needed food and they wanted to get a good deal, so their stores were super busy. So the stock hit its all-time highs just a few months after March. When a stock climbs in price really fast, there is usually a sell-off at some point. Even if the company is still doing well financially, people get scared and want to sell their stock and take in their profits because they think the stock may go down. They are putting up really good numbers, so I'm sure the stock will come back up well past its all-time highs. Since this company IPO, the S&P is up 144%. This company's stock is up 217%. You would have been a lot better off investing in this company than the S&P 500. They have a beta of 1.26, so the stock is a little more volatile than the market. It's gone down 27% in the past 52 weeks. While the S&P is up 34%, the 52-week low was 58, the high was 124, and the stock is trading between its 50-day and 200-day moving average. Over 1 million shares have been traded each day on average the past 3 months. Of the 65 million shares outstanding, 60 million are on float. Yahoo Finance says 116% of the shares are held by institutions. You can't have over 100% of the shares held by institutions. I've seen this error before in Yahoo Finance, and they have a pretty high short percentage. 20% of the shares on float are shorted and 18% of the total shares are shorted. So it seems like the company always had a decent short percentage. It was around 8 to 10% for a few years, then it got up to 25%. Now it's at 18%, which is pretty high for a company. So a good sign is their employee count seems to be increasing each year. They're up to 7,100 employees. If you invested $10,000 into this company when they IPO'd, you'd be at $33,000 today. That's a solid annual return of 21%. There hasn't been much insider activity. Somebody bought 1,000 shares in September, and another person sold 6,000 shares in July. The biggest shareholder is Fidelity at 12%. Then the next one is 11%, then 10%, then Wellington at 9%, and Vanguard at 8%. Let's look at their financial ratios. They have a good PE of 22. That's pretty good because they are growing a lot. If they were pretty flat in their growth, a PE of 22 isn't so great. A company who's growing 0% up to 3% a year, I would want a PE below 15. And they have a good price to sales of 2.4 and a good price to book of 3.1. They have a high ROE of 14%, much higher than the market median and average. And they have a good current ratio and quick ratio. They have lots of cash on their balance sheet, $444 million, and lots of inventory, $373 million. Because at any given time, they're always sitting on a lot of inventory. But that inventory gets turned over pretty quickly. They seem to be well capitalized. They had $163 million of free cash flow in 2021, $581 million of working capital, so they have $744 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 8 companies in the same industry as Ollies, and if Ollie has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better than average in price to earnings. They are worse in price to sales, a lot better in price to book. They have the highest current ratio of all these companies. Their ROE is above average. They're a lot lower in debt than the average company, and they're the second smallest company on this list. Big Lots is the smallest. And they don't pay a dividend. Most companies in this industry do pay a dividend. So to summarize, I have them trading at a 5% discount. So it does seem like the company is trading at the right price. But the stock price is not based off of the company's fundamentals. It's based off of supply and demand of the market. If more people buy the stock, the price will go up. If more people sell the stock, the price will go down. The good thing about investing in a company like this is that their products are always needed. People will always need to eat, and they're always going to need supplies to live. Other products become obsolete. Like at one time, landline telephones seemed like they were always going to be around, but now landlines are going away. Maybe one day cell phones will go away, there'll be something else new. But food will always be around. Plus, regardless of how the economy is doing, whether it's doing really good or really poorly, this company will always have demand. I rank their free cash flows 5 out of 10, their revenue 6 out of 10, and a ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.